Greeting for the day. Today we will learn about the journals. Are you guys excited to start the journey of journals? Click Start when you are ready to begin. Learning objectives. This module is aimed at helping the participants to understand the significance of journals, and in what way they contribute to the accounting in an organization. The purpose of this document is to ensure that all responsible employees are fully aware of their assignments, and their responsibilities are completed on time, properly and accurately in conjunction with the company's financial and internal control structure. What is journal? The recording process is the first step in the record-to-report cycle, known as journal, or bookkeeping or book of primary entry. Recording of a debit amount to one or more accounts, and an equal credit amount to one or more accounts, results in total debits being equal to total credits for all accounts in the general ledger. If the accounting entries are recorded without error, the aggregate balance of all accounts having positive balances will be equal to the aggregate balance of all accounts having negative balances. The rules for formulating accounting entries are known as golden rules of accounting. Accounts are classified as real, personal, and nominal accounts. Real accounts are accounts relating to assets and liabilities including the capital account of the owners. Personal accounts are accounts relating to persons or organizations with whom the business has transactions, and will mainly consist of accounts of debtors and creditors. Nominal accounts are revenue, expenses, gains, and losses. Transactions are entered in the books of accounts by applying the following golden rules of accounting. Real account, debit what comes in and credit what goes out. Personal account, debit the receiver and credit the giver. Nominal account, debit all expenses and losses and credit all incomes and gains. Accounting equation. Accounting equation double-entry bookkeeping is governed by the accounting equation. The accounting equation underlies the process used to capture the effect of economic events. If revenue equals expenses, the following basic equation must be true. If there is an increase or decrease in one account, there will be equal decrease or increase in another account. There may be equal increases to both accounts, depending on what kind of accounts they are. There may also be equal decreases to both accounts. Accordingly, the following rules of debit and credit in respect to the various categories of accounts can be obtained. A journal entry, in accounting, is a logging of transactions into accounting journal items. The journal entry can consist of several items, each of which is either a debit or a credit. The total of the debits must equal the total of the credits, else the journal entry is said to be unbalanced. In many organizations, all cash transactions, both receipts and payments, are carried out through subledger interface. These transactions are not directly posted into general ledger. However, during month-end closure, all non-cash adjustment entries such as accruals, depreciation and adjustment entries are posted in GL to get the actual overview of the business. These entries are posted in GL directly, and this is as per matching concept. Journal entries will be created by entering the details like date, period, account number, amount, currency, cost center or profit center, description. There are 3 modes of journal creation. Manual, when the accountant needs to propose the entry, and after the approval he can type it into the system and post it. Semi-automatic, when the accountant enter the required details in the predefined template, and once approved will be uploaded and posted into the system. Automatic, this is the case when as soon as the accountant triggers the posting key, the entry will be automatically posted by the system, for example, recurring entry, depreciation entry, system interface entry in the financial module, in case of restatement an entry for foreign exchange revaluation of both assets and liabilities etc. All journal entries created are approved before getting posted into the system. Once the entry is processed, system generates the document number for the transaction. This document number will be unique in nature. Proper supporting documentation for each and every entry should be archived for audit reason, with indication of the posting or reference number. Instances for manual entries. Manual entries are generally required at the time of reclassification, rectification, accrual entries, bank receipts, tax provision with estimated amount of tax for the year. Click each instance to know more. Key risks in journal entry creation process. Journals may be posted to incorrect account codes, wrong currency, etc. Double posting of any journal entry. Journals may be posted without authorization for the details and amount. Critical factors in journal entry creation process. Ensuring that all journal entries are supported by adequate documentation prior to posting the same. Ensuring all journal entries are routed for approval. Ensuring adequate segregation of duties between recording, reviewing and approval of journal entries. Ensuring all journal entries are created accurately for the correct amount, and in the correct accounting period. Ensuring that there is no elimination of any entry in a given period. Ensuring that entries are created within the timelines. Types of journals. Click each type to know more. Let's summarize the recording process. Bookkeeping process is part of the process of accounting, which primarily records the financial effects of transactions like purchases, sales, receipts, payments, etc. Double entry bookkeeping is a common system of bookkeeping. Two entries are recorded for each transaction that may occur in asset, liability, income, expense, capital accounts. As every entry requires a corresponding and opposite entry, so the aggregate balance of all accounts having positive balances will be equal to the aggregate balance of all accounts having negative balances. Accounts are classified as real, personal, and nominal accounts, and the rules for formulating accounting entries are known as golden rules of accounting. The equation assets equals liabilities plus owner's equity implies equality between total economic resources, assets, and total claims to those resources, liabilities and equity, so there will be a dual effect for each economic event affecting this equation. There are rules set out for assets, capital, liabilities, revenue and expenses accounts, explaining whether a debit or credit entry in the account will either increase or decrease the account balance. The dual effect of a transaction is recorded into a journal, and the total of the debits must equal the total of the credits. Generally, all cash transactions, both receipts and payments, are carried out through subledger interface, and all non-cash adjustment entries such as accruals, depreciation and adjustment entries are posted in GL. Journal entries are created by entering the details like date, period, account number, amount, currency, cost center, or profit center. Description. Three modes of journal creation are manual, semi-automatic and automatic. Journal entries are approved before getting posted, and system generates a unique document number. Proper supporting documentation should be archived for audit trail. Manual entries are generally required at the time of reclassification, rectification, accrual entries, bank receipts, tax provision with estimated amount of tax for the year. Situation when manual entries are required. Acquisition or disposal of a business. Upload of data from legacy systems. Managing failed batches. Adjustment entries for unreconciled items. Journals for manual assets creation. Key risks in journal entry creation are posting to incorrect account codes, wrong currency, etc., double posting, posting without authorization for the details and amount. Critical factors in journal entry creation. Supported by adequate documentation. No elimination/duplication of any entry. Adequate segregation of duties between recording, reviewing and approval. Accuracy for correct amount and accounting period. Types of journal entries. Accrual, deferral, allocation, correction or rectification, recurring, reversing depreciation, and closing entries. You have successfully completed this module on journals. Accrual journal entries. These are the entries which convert cash-based accounting systems into accrual basis. By posting accrual entries, expenses are recognized for a particular period, irrespective of whether cash is paid or not. Similarly, revenues are recognized irrespective of whether cash is received or not. Accrued expenses are those which are incurred, but not yet paid. Example. A company has a policy to pay commission on sales once in a quarter. However, every month it has to recognize commission on sales as an expense, to match the revenue with expenses for that period as per matching concept. Deferral journal entries. These are early payment or early receipt of cash, but at an expense or income for future period. Deferral entries increase or decrease cash flow, but do not affect P&L. Deferred expenses are future expenses for which cash is paid in current period. Example: Mr. John Doe, due to his family issues, has requested 2 months' salary in advance. The company management team has agreed to pay 2 months' salary in advance to the employee. In the below example, the salary advance entry passed in November 15 is a deferral journal entry. Allocation entries. Allocation entries. Allocation is the distribution of cost or revenue across multiple entities, profit or cost centers. Allocation entries are made by central offices to record the distribution of costs or collections in a central pool to the allocable cost, or profit centers, or entities. Cost allocation. An example of a cost allocation is when health insurance premiums are paid by the main corporate office, but allocated to different branches or departments. When cost allocations are carried out, a basis for the allocation, such as the headcount in each branch or department, must be established. Revenue allocation. Allocation entries are also made to distribute revenues received by a central or corporate office to related dependent offices or entities. Recurring entry. It is a journal entry for a business transaction that is repeated frequently, often at fixed intervals and fixed amount. An example of a recurring entry would be the monthly rent or an insurance premium. Recurring entries can be automated for similar or repeating entries. It will save time in creating the entry every time, as well as reduce the data entry errors. List of account heads for which accrual entries need to be passed on a recurring basis are predefined in the system. This is normally done at the beginning of each year. Reversing entry. These are the entries which are passed to reverse previously posted entries. The reversing entries may be done manually or automatically through system. Closing entries. Using the above information, we can prepare the following closing journal entries. Debit sales revenue 38,500. Debit rent revenue 250. Credit income statement 38,750. To close the revenue accounts to income statement. The first closing entry transfers the revenue account balances to income statement. Because revenue accounts have credit balances, they are debited to bring them to zero. After this entry is posted to the accounts, both revenue accounts have a zero balance. It is the final step in the journal processing cycle. The closing process serves a dual purpose. The temporary accounts, revenue and expenses, are reduced to zero balances, ready to measure activity in the upcoming accounting period. And these temporary account balances are closed, transferred, to retained earnings, via income statement, to reflect the changes that have occurred in that account during the period. Example, below is the account balances in the books of A Limited as on 31st of December 2008 in $. Please go through the closing entries given on screen. After this entry is posted to the accounts, the temporary accounts have zero balances and retained earnings have increased by the amount of the net income. After the closing entries are posted to the ledger accounts, a post-closing trial balance is prepared. The purpose of this trial balance is to verify that the closing entries were prepared and posted correctly, and that the accounts are now ready for next year's transactions. Depreciation entries. The purpose of the journal entry for depreciation is to achieve the matching principle. In each accounting period, part of the cost of certain assets, equipment, vehicle, gets moved from the balance sheet to depreciation expense on the income statement, so it can be matched with the revenues obtained by using these assets. The journal entry for depreciation contains a debit to the income statement account depreciation expense, and a credit to the balance sheet account accumulated depreciation. The account accumulated depreciation is reported under the asset heading of property, plant, and equipment. It is also known as a contra-asset account because it is an asset account with a credit balance. Because accumulated depreciation is a balance sheet, or real or permanent, account, its balance will carry over to the next accounting period. This means that its credit balance could get as large as the cost of the assets being depreciated. Correction or rectification entries. These are the entries, which are passed to rectify any errors occurred, while passing in original journal entry. Example, salaries paid for the month of Dec 15 for $10,256. However, an original entry was passed for $10,250, by error. So an adjusting or rectifying entry for the balance $6 will be passed in the books of accounts. Typically these entries are posted in the same period when identified. However, such errors may be discovered at a later period and corrected immediately in the same period when the error got discovered. Supporting documentation for a correction entry would include copies of the transaction in error and explanation of the mistake and correction needed.